In today's video, we are going to break down the complete business model of one of the most talked about companies in the world, Tesla. Many people think Tesla is simply an electric car manufacturer, but if that were true, it would be difficult to explain why Tesla has often been valued higher than traditional auto giants that sell many times more vehicles. So the big question is, how does Tesla actually make money? And what makes its business model so different from other car companies? To understand this fully, we need to go beyond the cars and look at Tesla's strategy, revenue streams, cost structure, innovation model, and long-term vision shaped by its CEO, Elon Musk. At first glance, Tesla appears to operate like any other automaker. It designs, manufactures, and sells electric vehicles such as the Model S, Model 3, Model X, and Model Y. Automotive sales still make up the majority of Tesla's revenue. However, what separates Tesla from traditional automakers is its approach to margins. While many legacy car companies operate on relatively thin profit margins, due to dealership commissions, advertising costs, and complex supply chains, Tesla has built a vertically integrated system. Vertical integration means Tesla controls much of its production process, from battery technology to software development, reducing dependency on third parties. This control allows Tesla to optimize costs, improve efficiency, and maintain higher profit margins compared to many competitors. One major difference between Tesla and traditional car companies is its direct-to-consumer sales model. Most automakers rely on dealership networks to sell vehicles, which adds an extra layer of cost and reduces control over customer experience. Tesla bypasses dealerships entirely and sells directly through its website and company-owned stores. This approach reduces distribution costs and gives Tesla full control over pricing, branding, and customer data. It also allows the company to adjust prices quickly based on market demand, without negotiating with independent dealers. This streamlined sales model is one of the foundational pillars of Tesla's profitability. Another crucial element of Tesla's business model is software. Unlike traditional automakers, Tesla treats its vehicles as software-driven machines. Each car is equipped with advanced onboard computers and receives over-the-air updates. This means Tesla can improve vehicle performance, add features, and fix bugs remotely without requiring customers to visit service centers. Over-the-air updates reduce service costs while increasing customer satisfaction. More importantly, Tesla monetizes software features such as its full self-driving FSD package. Customers can pay thousands of dollars upfront or subscribe monthly for access to advanced driver assistance features. Software sales have extremely high profit margins compared to hardware, making this a powerful revenue stream. In addition to automotive sales and software, Tesla generates significant revenue from regulatory credits. Governments around the world have introduced emissions regulations to combat climate change. Automakers that produce fewer emissions are awarded regulatory credits, while those that exceed emission limits must purchase credits from companies that have excess. Because Tesla produces only electric vehicles, it earns surplus regulatory credits and sells them to traditional automakers. For several years, these credits contributed substantially to Tesla's net profits. Although Tesla aims to rely less on this revenue over time, regulatory credits played a critical role in helping the company achieve sustained profitability during its growth phase. Energy generation and storage represent another important component of Tesla's business model. Beyond cars, Tesla produces solar panels, solar roofs, and energy storage products like Powerwall and Megapack. These products allow households and businesses to store renewable energy and reduce reliance on traditional power grids. While energy currently contributes a smaller percentage of revenue compared to automotive sales, it is strategically important for Tesla's long-term mission. The company's vision is not just about selling vehicles, but accelerating the world's transition to sustainable energy. By combining electric vehicles, solar power, and battery storage, Tesla creates an interconnected ecosystem of clean energy solutions. Battery technology is at the heart of Tesla's competitive advantage. Batteries are the most expensive component of an electric vehicle. By investing heavily in research, development, and in-house battery production, Tesla has managed to reduce battery costs over time. Lower battery costs mean lower production expenses and higher margins. Tesla's gigafactories, massive production facilities located in different parts of the world, enable economies of scale. Producing batteries and vehicles at large scale reduces per unit costs, allowing Tesla to remain competitive even while adjusting prices in response to market conditions. Brand power is another hidden strength in Tesla's business model. Unlike traditional automakers that spend billions annually on advertising, Tesla spends almost nothing on paid advertising. Instead, it relies on word of mouth, social media buzz, and the public presence of Elon Musk. Musk's online engagement often generates massive free publicity for Tesla. Product launches and announcements become viral events, reducing the need for conventional marketing budgets. This unconventional approach significantly lowers operating expenses while keeping the brand constantly in the public eye. Tesla's valuation has often puzzled investors. The company has, at times, been valued higher than automakers that produce several times more vehicles annually. This is because investors do not see Tesla as just a car company. Many view it as a technology company, a software platform, and even an artificial intelligence company. Tesla collects vast amounts of driving data from its vehicles, which helps improve its autonomous driving algorithms. If Tesla successfully develops fully autonomous vehicles, it could unlock entirely new revenue streams, such as robotaxi networks. In such a scenario, Tesla vehicles could generate income for owners and for Tesla itself, transforming the company's business model from product sales to service-based recurring revenue. Cost control has also been central to Tesla's strategy. The company continuously seeks manufacturing efficiencies, redesigning components to reduce complexity. For example, Tesla has introduced large casting techniques that replace multiple smaller parts with single, large pieces. Fewer parts mean faster assembly, lower labor costs, and fewer potential defects. These incremental efficiencies add up significantly when producing millions of vehicles. However, Tesla's journey has not been without challenges. The company has faced production delays, supply chain disruptions, regulatory scrutiny, and intense competition from both established automakers and new electric vehicle startups. As more companies enter the EV market, competition pressures pricing and margins. To maintain growth, Tesla must continue innovating while controlling costs. It also faces risks related to raw material prices, particularly lithium and other battery components. Another factor influencing Tesla's revenue is geographic expansion. Tesla has built gigafactories in multiple countries, allowing it to serve regional markets more efficiently and avoid high import tariffs. Localized production reduces shipping costs and improves delivery times. Expansion into emerging markets also opens new growth opportunities as electric vehicle adoption increases worldwide. A key element of Tesla's strategy is long-term thinking. Many traditional automakers prioritize short-term profits and quarterly performance. Tesla, on the other hand, has often reinvested profits into research, infrastructure, and new product development. This reinvestment approach initially led to years of losses, but it positioned the company for rapid scaling once production challenges were solved. Investors who believed in Tesla's long-term vision were rewarded as the company transitioned from struggling startup to industry leader. Cash flow management is another critical piece of Tesla's financial health. As vehicle production scales, upfront capital requirements are high. Building factories, developing technology, and expanding charging infrastructure require billions of dollars. Tesla has raised capital through stock offerings and debt in the past, but improved profitability has strengthened its balance sheet. Strong cash reserves provide resilience during economic downturns and allow continued investment in innovation. Ultimately, Tesla's business model can be understood as a combination of automotive manufacturing, software monetization, energy solutions, regulatory credits, and technological innovation. Each component supports the others. Vehicles generate data to improve software. Software increases margins. Energy products align with the sustainability mission. Brand strength reduces marketing costs. Vertical integration enhances efficiency. Together, these elements form a business ecosystem rather than a single revenue stream. In conclusion, Tesla's success is not accidental. It is the result of strategic vertical integration, direct sales, software monetization, regulatory credit revenue, energy diversification, manufacturing innovation, and bold long-term vision. While automotive sales remain the foundation, Tesla's true strength lies in its ability to operate at the intersection of technology, energy, and transportation. Whether the company continues to justify its high valuation will depend on its ability to maintain innovation, scale efficiently, and deliver on ambitious promises such as autonomous driving. Regardless of future challenges, Tesla has undeniably reshaped the automotive industry and redefined what a car company can be in the modern era.